Hey, hi everyone. Welcome to another video in our hedge fund series. So today we are going to go into details into the event-driven hedge fund strategy. So the last video we have discussed about Daniel S. Loeb and his hedge fund and the event-driven hedge fund strategy. But yeah, today's video is like more deep dive into this event-driven hedge fund strategy, and we will look at the various examples from US and as well as around the world where this strategy has been deployed by different hedge funds. So, an event driven hedge fund strategy basically seeks to profit from corporate events. Okay. And basically, these corporate events which will significantly impact the company's stock price or valuation. So, some events which are typically are mergers, acquisitions, bankruptcies, spin offs, restructurings, or regulatory changes. So, this strategy involves analyzing how this event might affect the company's valuation or the stock price, and then taking a long or short position to capitalize on this potential mispricings. Okay, so it basically tries to seek profit from corporate events and how these corporate events will impact the stock price or the price valuation. And the events typically are mergers, acquisitions, bankruptcies, spin-offs, restructurings, and regulatory changes. And based on their view, they take either a long or a short position to capitalize on the potential mispricings. So, example of for this event-driven strategies, which the key types of event-driven strategies are merger arbitrage. So, whenever there is a mergers and acquisition deal that's happening, these hedge funds, what they do is they basically take a trade on the success or failure of this merger and acquisition deal, and they buy the target which is being and short the acquirer. So the company that is being acquired, they buy that expecting the price to rise, and short the acquirer. They'll short the stock of the company that is acquiring. Example is buying Activision Blizzard after Microsoft's acquisition offer. So Microsoft has put an acquisition offer for Activision Blizzard in this example, and the company, the hedge fund, will basically buy this Activision Blizzard and sell they may sell Microsoft or they may not, but they will buy expecting that the Activision Blizzard price will increase. In this example, they only bought; they didn't short the Microsoft stock. Okay, distressed restructuring or investing. So some companies would be going through bankruptcies or restructurings or turnaround situations. So those are distressed companies, and these hedge funds will invest in those distressed companies and also in restructuring certain companies so that they can bring a turnaround in that company. And during when the company is in a distressed state, generally its stock price will be very low. And if these hedge funds can infuse some money and bring a turnaround, and they can buy at a very cheap price, then they will make huge profits. So like example is buying Lehman bonds at deep discounts in 2009, expecting a recovery. So that's an example. Spin-offs also is an event that these companies use, the hedge funds use to do the trading. So that's what they do is invest in parent or spun-off entities where the market has mispriced one of the parts. So example is investing in PayPal after it was spun off from eBay. So they'll do that. Like spin-off companies also, they'll invest if they feel like this company has a huge potential to grow. Then they will put a lot of money into, for example, in this case, PayPal, expecting the price to rise further, and they benefit from that particular trade. Okay. The other type of event that these hedge funds use are regulatory or legal catalysts. So they take positions around outcomes of legal rulings. Generally, pharma companies, this is applicable. FDA approvals or regulatory changes. If FDA approves certain drug, they invest in that company based on that approvals or any regulatory changes. Also, they'll use to do the hedge fund investments. Example is investing in biotech stocks before FDA decisions. Okay, and yeah, they also do tender offers and buybacks. That is another event which these hedge funds use to do the trading, which is take trade around corporate actions like share repurchases or tender offers. Example is arbitraging Dell's go private tender offer. So these are the different events which they used to do this event-driven strategy. The hedge funds used to do event-driven strategy, merger arbitrage, distressed structuring or invest restructuring, investing, spin-offs, regulatory legal catalysts, or tender offers and buybacks. Okay, so what are the top hedge funds using these event-driven strategies? We already discussed about in US the Third Point LLC. Daniel S. Loeb is famous for using this merger arbitrage and also activist investing and special situations. Okay, his focus is on that. Notable trades that he has done using event-driven strategies are took activist stake in Yahoo and forced CO changes. So that is one of the deal he has done. And Dow Chemical plus DuPont merger. So this event-driven bet on synergy value. So basically, this merger has more synergies, and they expect the price to rise. So that's what this particular trade is. Elliott Management. So this is also a US hedge fund, and Paul Singer is the founder of this particular hedge fund, and it also is involved in event-driven strategies. So distressed debt and activist event-driven strategy is used by this hedge fund. Notable trades are Argentina debt restructuring, sovereign default litigation. So that is one thing. So this is like distressed debt strategy. So they basically did a restructuring for the Argentina debt, and yeah, once the country recovered again back, then they made a lot of money through that. AT&T plus Time Warner merger opposition. So they also opposed the AT&T plus Time Warner. Okay. Yeah, so that is another important trade by Elliott Management. Pershing Square, we discussed about Ackman and his activist and event-driven strategy. He is more famous for activist, event-driven, as well as long-short strategies. He goes long on companies he has conviction for. Yeah, so notable trades are Herbalife short position. So he has taken a short position in Herbalife based on his activist short thesis, assuming that it is basically a pyramid scheme. Canadian Pacific, this CEO replacement and operational improvement has been done by doing um, activist investing. Carl Icahn is famous activist investor, and he is activist event driven guy. So he has his main bets are Apple, Dell, eBay. He prepared boards for spin-offs and dividends, more dividends. Okay. So other hedge funds which use this event-driven strategy worldwide are CI Investments. This is Signature Global Income and Growth Fund. This uses global event-driven strategies, including spin-offs and distressed investing. And Chain Capital, Great Britain, is focusing on event-driven credit, particularly European distressed debt. Okay. Fangrove Capital, this specializes in merger arbitrage and special situations globally. And Soros Fund Management, although known for macro trades. So this is George Soros fund. He is generally regarded as a global macro hedge fund manager, but it has also engaged in event-driven investing, like leveraged stake in Time Warner. Why these event-driven strategies are profitable? Because of information asymmetry. So smart hedge funds can analyze these situations thoroughly, like what would be the outcome of this merger or acquisition or the spin-off or this regulatory change or this restructuring of a debt or this bad debt or distressed debt. All this they can analyze that situation more thoroughly than retail investor. So they have that information asymmetry, and based on their deep analysis, they can make a basically predictable and more probable trade, thus benefiting from that trade. Inefficient pricing, because we don't know the probability of that merger and acquisition being successful or failure, and that regulatory change bringing the price up or down, whether it gets approved or not, even that regulatory change like FDA approvals. So there is some uncertainty there, and these guys basically use the data, and they trade on the probability of that, and they basically take on a highly probable situation. The other one is hedging capabilities. So risk can be tightly managed, okay, in merger arbitrage with paid trades. So so paid trades also they'll take. Basically paid trade is like in that Activision Blizzard basically. So what you'll do is you'll basically buy the Activision and short the Microsoft. So in any case, anything happens, so you will basically benefit from the spread between these two stocks. Both goes up, also you will make a lot of money. So basically, yeah, its hedging capabilities are also there in these event-driven strategies, especially with paid trades and merger arbitrage. Risk is also there in the event-driven strategies. Deal break risk. So you assume that you basically traded assuming that that M&A deal will go through, but if it fails, then yeah, that stock crashes, and then you will basically incur losses. Regulatory risk, antitrust regulations, like if some competition commission says, these deals like Time Warner plus AT&T, this can't go through because it restricts competition, then again you will have a risk there, regulatory risk you will have from the government. So if whatever you anticipated, if that doesn't happen, then you will again incur losses there. Litigation, legal risk. So legal things, if they pop up like in distressed debt or yeah, distressed debt especially, then or regulatory issues, approvals, then outcomes, basically if it goes on a slow long legal battle, then it will destroy your investment thesis, lock your capital also. Okay. Timing risk, so events can take longer than expected. So you assume that this M&A will go through, but or this spin-off will happen, or this drug will get approved, or this regulatory change will come, or this distressed asset after restructuring will go up. But it takes time, right, to have for that to happen, and your capital is tied up there. So there is a timing risk also. Volatility, so if any new policy changes come, then it hits your position very hard. Okay. Unexpected news or policy changes will come, then it will hit your position very hard. Like any unexpected news like corona, for example, if it comes, then yeah, basically both will go down a lot, then you will incur losses. Merger arbitrage example is Microsoft's acquisition of Activision Blizzard. So Microsoft offered $95 per share for Activision in 2022 to 2023. Market reaction, it Activision traded below 78 to $85 due to antitrust concerns. So in this case, what these hedge funds will do is they'll buy Activision shares, betting that deal would get closed and the spread would close to $95. So it was trading at $78, right, to 85. So they will basically buy that at 78, and once the deal goes through, the stock price will go for 95. That's what they will expect. And that deal eventually closed, and these arbitrage funds profited from this spread. So 78 or 85 minus 95 is $10 profit they have made. Okay, per share. Yeah. Again, core goal, profit from price inefficiencies created by corporate events, this event driven strategy. Time horizon, short to medium term will be there. Common events and mergers and acquisitions, spin offs, restructuring, distressed debts, like regulation. Okay, main risks are deal failure, regulatory blocking, time delays. Top US funds that use these are Third Point, Elliott, Pershing Square, and Icon. Global funds are Sandgrove from UK, Chain Capital from UK, and CA Investments from Canada. So that's the details about event-driven strategies. So I touched upon it in when we went through Daniel S. Loeb Third Point hedge fund, but I wanted to cover it in detail. So this video is hedge fund strategies. We already covered global macro strategy. We covered contra uh, trading strategy, and we covered the quant strategies. So this is the event-driven strategy that we are covering today. Thanks everyone for joining the call. Have a nice day. Bye.